Brad, let's begin with you, please. For the record, your name is Brad Reynolds, and you are testifying on behalf of the Comptroller of Public Accounts. Is that correct?
Yes, sir, that's correct.
Thank you, sir.
I'll be doing just an overview of the biennial revenue estimate as we just released it the day before session convened in January. If you want to follow along the slides, you should have.
Hey, Brad, can you get a little closer to the microphone? I'm having a little bit of trouble hearing you.
Okay. Is that better now?
Yes, sir.
Okay.
Thank you.
I'm going to just go through a general overview of the biennial revenue estimate as we just released it in January. And if you want to, you should have electronically these slides or a handout. I see you have a physical handout, okay? So I'll begin with the first page of that, and we're projecting for the 26-27 biennium a total revenue available for appropriation of $194.6 billion. That's down slightly from what we now estimate was total available revenues for 24-25 biennium. That slight decline is not due to a declining economy or lower forecast of revenue growth, but included in revenue available to spend in each biennium is revenue collected during that biennium plus the remaining cash balance from the prior biennium. 24-25, we now estimate the beginning balance for that biennium was a little in excess of $39 billion. Our projection of the ending balance for that biennium and your beginning balance for 26-27 is $23.76 billion. So it's the smaller beginning balance, $39 billion versus 23.7 is the explanation for the decline from biennium to biennium in available revenue. Also on that sheet, I will point out this is different for this biennium than you have had previously in a significant way. Not all of the tax revenue from severance taxes that normally is allocable to the Economic Stabilization Fund will be transferred to that because there is a constitutional limit on the balance in the Economic Stabilization Fund that will prevent us from transferring the oil and gas severance tax revenues normally allocable to that fund, and that will remain in general revenue. And on the sheet to the right, that amount is $5.6 billion in 26-27 is oil and gas tax severance tax revenue that normally would be allocable to the Economic Stabilization Fund, but will not. It will be general revenue in 26-27. And then combined with $300 million in that amount for the current biennium, a total of $5.9 billion of your available revenue this time is due to severance tax revenue that is retained in general revenue instead of going to ESF. So to the next slide, and that's what I've already referred to, and the certification ending balance each biennium is the starting balance for the subsequent biennium. And you had almost $39 billion in 23, and that's pulled back down to 23.7 this time. And I think the thing to understand about the ending balance that is projected for the current biennium that will be available to you in 26-27 is that fundamentally is due to decisions by the last legislature to not spend all of what was available last time. This is really surplus or excess funds that were accumulated in the 22-23 biennium that was not spent in 24-25 and is carrying forward further. It is not due to what I would describe as a structural surplus, which would be the case if you had revenue system that was growing in revenue significantly faster than population inflation or your spending measures. That's not the case. This is substantially leftover surplus accumulated back in 22-23 when we had historically high inflation and historically high infusions to the state budget from federal funds that were authorized by Congress during the pandemic. And so you had your large accumulation of surplus funds occurred in 22-23, and we're seeing that dribble down over time. But I just want to emphasize that this ending balance that we project for 24-25 is not because revenues have taken off and grown much faster than we anticipated or was anticipated when the previous legislature wrote the budget. That's, in fact, for fiscal 24, we came in just slightly below estimate for tax revenues.
And Brad, let me interrupt you just real quick. Chair recognizes Vice Chair Martinez Fisher.
Thank you, Mr. Chairman. Can you break down the revenue from 22-23, 24-25?
Yeah, let me pull it's not in your handout, but I do have that information with me. Well, in fiscal 22, on an all funds basis, we had sales tax grew by 19.3% over 21. Motor vehicle sales tax grew by 12.5%. Franchise tax grew by 25%. Oil production tax grew by 84%, but that's because the oil price recovered so strongly from it dropping in the pandemic.
And for my purposes, I mean, not to disrupt your presentation, I'm just curious in the dollar amount, if you could tell me what we carried forward in those 2 fiscal years.
I can't really do that by carry forward because the carry forward bound is a function of both spending and revenue.
Right. But I guess your statement is that we don't have a structural surplus. We have a surplus as a result of not spending in the last 2 fiscal years. And I'm trying to figure out at the ending of fiscal 22-23, what do we in effect carry forward and then repeated in 24-25?
Right. Your ending balance at the end of 22-23 was a little over $39 billion. And that was your starting balance for the biennium you're in now. And that's what I'm wanting to say is that was a historical anomaly due to events that occurred in the pandemic. And one of them being an infusion of federal funds well above normal that allowed budget writers to substitute in instances federal funds for what normally would have been general revenue spending. You were able to spend federal funds instead, so that contributed to accumulating unspent state funds. You also had, coming out of the pandemic, once the restrictions were lifted and households started going out and spending again, that coming out of the pandemic, we had a big takeoff in the rate of inflation because we'd had a lot of supply chain disruptions occurred during the pandemic, which limited supply of things that goods particularly that households and businesses were trying to buy. That put upward pressure on prices, and a lot of the federal funds that were injected into the economy in 20 and 21 had not been spent during that period because of restrictions and reduced activity by households and businesses.
Sure.
So the household sector accumulated what came to be called excess savings, a big balance of funds in excess of like normal income. Basically, savings went way up during the pandemic, supported by additional funds, transfers to the household sector by the federal government, so that when restrictions ended and everyone started spending again, you had a big increase in monetary demand for goods and services, financed by that extra savings, combined with cost pressures due to supply chain disruptions. And those two factors together resulted in a big imbalance between demand and supply. Prices rose, but the households and businesses were able to spend and pay the higher prices, not everybody, of course, but many, because they had the excess savings.
No, I appreciate that. And for the beginning balance of fiscal 24-25, do you have that number?
The beginning balance for 24-25?
Yes, sir.
That's the $39 billion.
And what was the beginning balance for 22-23?
That I don't have. I'll have to get back to
Okay.
you, but it would have been, wait a minute, I do have it. It's slightly over $10 billion. It's on your second page of the handout. I don't have, the dollar amount is not there, but on the graph, you can see the bar for 2021.
Yes, sir.
That's your ending balance for 2021, starting balance for 2022.
Okay,
So a
thank you.
little over 10.
Thank you very much. Thank you, Mr. Chairman.
Okay. The third page of the handout is some data on your largest source of tax revenue is sales tax. That's over 50%, typically 54%, I think, in the upcoming biennium is our projection of your revenue will be from tax, from sales tax. And this is just to compare sales tax and total tax collections, how they've grown in the last 4 years. We're projecting now that sales tax will grow about 4.5 or 4.6% per year in the upcoming biennium, which is slightly below the longer-term historical average rate of growth. But there have been changes in the composition of particularly household spending in response to the way inflation has played out in the last 3-4 years. Larger shares of household budgets are now being spent on things that are not in the sales tax base, such as insurance, which have had extremely high increases in insurance costs, as well as housing and rental costs. Those are not in the sales tax base, and they're claiming a larger average share of total budgets than formerly. So we now anticipate sales tax to grow somewhat more slowly than overall income. And that's because a higher percentage of budgets are going to items not subject to sales tax. Another item that's big to households, of course, is the cost of food. There's been significant inflation in prices of both food for at-home, groceries, or food away from home. And that expense is also taking a higher share of household budgets. And food purchased for consumption at home, that is groceries, is not in the sales tax base. So that's why we're projecting sales tax to grow a little bit more slowly than overall income, and it's just because of that shift in budget shares. The fourth sheet in the handout just has some information on our oil production tax. It's the most volatile, the oil and natural gas taxes both are the two most volatile taxes in your tax system because there's such volatility in energy prices. So from year to year, we'll get really large, significant swings in oil tax revenues and sometimes natural gas tax revenues as well. This volatility will have more significance for budgeting going forward because, as I mentioned on the first slide, because of the cap on the Economic Stabilization Fund, going forward, you're going to have significant money this biennium and any future biennium, we would anticipate, of money from oil and gas severance taxes that will not go to ESF and will be general revenue. So your general revenue is going to be slightly more volatile as a result of that. The following sheet is to summarize the transfers to the Economic Stabilization Fund and the State Highway Fund. It's a little bit difficult to compare this directly to what is happening in the GR revenue statements because we reserve from available revenue in 1 year what we must transfer to the State Highway Fund and the Economic Stabilization Fund in the following year. But on this sheet, you see we've got in fiscal 26 scheduled to or estimated will be transferred $2.45 billion to the State Highway Fund. But only $2.15 billion to the Economic Stabilization Fund from severance taxes. The remaining $300 million difference between what goes to the Highway Fund and what will go to the Economic Stabilization Fund is amount that cannot transfer because we expect the Rainy Day Fund or Economic Stabilization Fund to be at its cap at the start of fiscal 26. And then the following year, no severance tax will transfer. So you'll have $2.64 billion remaining in GR. Nonetheless, over time, even though there is a cap, the cap on the Economic Stabilization Fund only stops us from transferring funds into the fund. It does not, the Texas Constitution does not give controller authority to transfer out anything from the Economic Stabilization Fund in order to stay within the cap. So the balance in the Economic Stabilization Fund will continue to grow because the fund has investment earnings, and those investment earnings will remain in the Economic Stabilization Fund, and that balance will continue to grow over time. While it is above that cap, though, there's one other, and it's a smaller amount of money, but about $100 million a year. Only the fund has both interest and investment earnings. The interest earnings, the part of the balance that is just earning interest, that interest earnings is allocable back to the general revenue fund. In 26-27, about $100 million a year in interest earnings from the Rainy Day Fund will be contributing to general revenue. And anyway, that condition will persist as long as the fund is above the cap. The cap is computed as 10%. The cap for any one biennium is 10% of general revenue deposits in the previous biennium. And so that cap will gradually grow over time as general revenue grows over time, but not fast enough to accommodate money from severance taxes. I guess that relationship between the cap and the ending balance in the Economic Stabilization Fund is summarized again on the following table. And then the last, if you'll just turn to the last table, or last sheet. The controller had us do a comparison of how that economic stabilization fund balance would grow over time if there were not a cap. And so in the light blue bars represent the amount of growth that would continue to go on in that fund if the constitutional cap did not prevent us from transferring severance taxes into the fund. Over time, that's a considerable difference. We would project the economic stabilization fund balance would reach $80 billion by 2035, but with the cap, it will reach a little bit less than $40 billion. So during all those years, then there will be severance tax that remains as GR because it's not transferring over there. And as I said, that gives you a little more volatility in your revenue mix. But so that concludes these tables. Are there any further questions?
Thank you very much. Members, any questions? Thank you for your testimony. Let's move on to Mr. Ashley. For the record, your name is Philip Ashley, and you are testifying on behalf of the Comptroller of Public Accountant. Is that correct?
That is correct.
I'm glad to tell you I'm also your fellow CPA. Okay. Please
Very
go
good.
ahead.
Yes, ma'am. Good morning, members. My name is Philip Ashley. I am the Associate Deputy Controller for Tax Administration at the Comptroller's Office. I'll be providing a very brief overview of state taxes administered by the agency. You should have a copy of my presentation in your materials. It is titled Overview of State Taxes. The Comptroller's Office administers more than 60 separate taxes and fees on behalf of the state. Let me assure you, I don't plan to try to cover all of those in my presentation today, but the point being that the state's revenue system, of which state taxes are the main source of general revenue funding, is both extensive and complex. The agency looks forward to being a helpful resource to you as you conduct your deliberations this session, in addition to providing subject matter resources on different tax topics as needed. I also wanted to quickly highlight a couple of helpful publications that we have made available to you, and those are listed on page 2 of your handout. The first is our field guide to the taxes of Texas, which I'm holding up here for you. This is a not quite pocket-sized publication that serves as a quick reference on the state's major taxes. It provides a brief history of each tax, as well as historical amounts collected, estimated future collections, which mirror our estimates in the biennial revenue estimate, tax rates, information about who pays the tax and where the tax is deposited for purposes of the state's fund accounting system. It does not cover every tax that the agency administers, but focuses on the more significant ones. By contrast, our sources of revenue publication, which is this one here, it contains a more comprehensive listing of state taxes and fees and includes a detailed legislative history for each going back to 1972. And then lastly, our tax exemptions and tax incidence report provides information and estimates about the value of each exemption and exclusion associated with the state's major taxes plus property taxes, and it also includes information on tax incidence, which is an analysis of who ultimately pays the tax. These are all resources that may be helpful to you in the course of your work, and if you have any questions or need assistance with them, we're happy to provide it. I'll proceed now with a very quick overview of the state's major taxes. For the sake of time, I'm only going to talk about 2 in any amount of detail, those being the state franchise tax and the sales and use tax, the 2 taxes that typically receive a larger share of the limelight. But I've also included in your handout, towards the latter part of your handout, some information about other taxes that we administer. Turning to page 3 of your handout, I'll begin with franchise or margins tax, which is one of the state's oldest taxes, originally implemented or enacted in 1907. The franchise tax is a tax that is levied on the privilege of doing business in Texas. It's generally paid by corporations, limited liability companies, certain partnerships, trust, and other business forms. The tax itself is computed on the entity's margin, which is defined as the total revenue less the greater of one of four deductions, the first being cost of goods sold, second is compensation, the third is 30% of total revenue, and the last is $1 million. The margin is then apportioned based on Texas receipts versus everywhere receipts and multiplied by the appropriate tax rate. There is also an alternative calculation referred to as the EZ computation for entities that have less than 20 million in revenue, total revenue, and that does not involve, computation of that tax does not involve determining the margin. It only requires applying the EZ tax rate to the apportioned revenue. The various rates for the franchise tax are listed for you on page 4 of your handout. The current tax rate for entities classified as retail or wholesale entities is 0.375%. The rate for all other entities is 0.75%. And then, as I mentioned, there is a separate rate for the EZ computation, which again is for entities with less than 20 million in total revenue, and the rate for that computation is 0.331%. Entities having total revenue of 2.47 million or less owe no tax, and taxpayers who would owe tax, but that tax is calculated at less than $1,000 or less, owe no tax. And I'll note here that the current no tax due threshold, the 2.47 million, that was increased this past legislative session. That was in the 88th session, second called session, by Senate Bill 3, increased that no tax due threshold from 1.23 million to 2.47 million, where it stands today. Turning to page 5 of your handout, for tax year 2024, there were a total of 2.9 million registered franchise taxpayers. But as you can see there on the slide, the vast majority of registered franchise taxpayers don't actually end up paying any tax, less than 150,000 this past year out of that 2.9 million total paid tax due to the operation of that no tax due threshold and various other exclusions that may be applicable, such as the veteran-owned business exemption. Senate Bill 3 had a significant impact on the number of franchise tax reports that the agency receives. We received about 2.2 million total reports in fiscal year 23 compared to fiscal year 24, where we received less than 500,000. In fiscal year 24, the franchise tax brought in a total of $6.86 billion into the state treasury, which represents about 8.4% of total all funds tax collections, and the tax is due annually each year on May 15th. Turning to page 6 of your handout, I'll move on to the state sales and use tax, and as Mr. Reynolds mentioned in his testimony, the sales tax is really the workhorse of the state's tax system. It is the single largest source of revenue for the state, raising about 58 cents of every dollar of state tax revenue in fiscal 24. It is a transaction-based tax. It's generally imposed on the final sales, leases, and rentals of tangible personal property, and on certain services which are enumerated in state statute. The state collected a total of $47.16 billion in sales tax in fiscal 24. The state sales tax rate is 6.25%, but local taxing jurisdictions, including cities, counties, and special purpose districts, can impose an additional local sales tax rate up to a combined local rate of 2% for a maximum combined state and local rate of 8.25%. Turning to page 7 of your handout, I mentioned that in addition to tangible personal property, the sales tax also applies to certain services which are enumerated in state statute, and I've listed those taxable services for you there on page 7 of your handout. There are a variety of different sales tax exemptions available to taxpayers. The most significant of these are listed on page 8 of your handout. I won't talk about these in detail, But we'll point out that that publication that I highlighted earlier, our tax exemptions and tax incidence report is a very good source of information about each of these individual exemptions. It includes the controller's estimates for what each of those exemptions cost the state in terms of foregone tax revenue. Major exemptions include tangible personal property that is taxed under other law, such as oil, taxed under the oil production tax, fuels covered by motor fuel taxes, motor vehicles covered by the motor vehicle sales tax, alcoholic beverages taxed under the mixed beverage tax, and so on and so forth. Food for home consumption, essentially groceries, and certain healthcare supplies, such as prescription medicines, are both exempted from the sales tax. A couple of other notable exemptions are the sale for resale provision, which exempts the sale of a taxable item to a purchaser who will then resell the item, and the manufacturing provision which exempts certain inputs into the manufacturing process that become part of the final product for sale, as well as certain equipment that is directly used in the manufacturing process.
Madam Chair, I have a question.
The chair recognizes Vice Chair Martina Fisher.
Thank you, Madam Chair. On the sales tax, does the Comptroller have a publication or report that sort of leans in to give us more detail as to what that taxpayer looks like, demographics, income?
Yes, sir. So our tax exemption and tax incidence report, that would be part of the incidence portion of that publication. So, and we've given you a copy of that. in your
Perfect, yes,
materials
I have
today.
that. And so would it cover, I haven't looked at it yet, but would it cover, like, say, for instance, I'm looking at a general population of sales taxpayers that also are property taxpayers. They say they own a home, they pay their own property tax directly. And then I want to look at sales taxpayers who may not pay property taxes directly by paying directly to the taxing authority. They may pay rent, which might have some component of property taxes in there. Does the Comptroller have any reports or data that speak to that?
I do not believe that we do, Mr. Chairman, and we could follow up with you to talk more specifically about the data you're looking for to see if that's something we could provide or not.
And I guess maybe from a more general purpose, if I wanted to know the number of taxpayers we have in this state that pay sales tax but perhaps don't pay direct property tax because they don't own a home, is that a number we can get from the agency?
There are estimates of the portion of total sales tax.
Here, why don't you-
In the incidence tables in that report, on page 51, the lower right-hand box has final estimated incidence of sales tax by home ownership or renter status.
Can you walk me through that, please?
Yes, sir. This is a forecast year. These estimates are for fiscal 27 forecast, but for total sales tax forecast of $54.8 billion, the estimate is that homeowners
And again, tell me what chart you're on again, I'm sorry.
on page 51 of the tax
Can you
incidence study.
Oh, okay, thank you, thank you.
Okay. Page 51, the box that's on the bottom left?
The lower right.
Lower right, okay, I'm sorry. Oh, okay, I see it.
And that distinguishes amounts between homeowners and renters, amounts of the sales tax estimated to be paid.
But does it tell us?
On what's called final incidence. And final incidence is different from who pays tax initially. That is, there's an assumption built into the modeling for this that for the most part, sales taxes paid by businesses will be pushed on into prices or reduced income to shareholders or reduced wages and salaries than they would otherwise pay in the absence of the tax. So basically that table is assuming all of your taxes are ultimately paid by the household sector. And so then it's estimating how much of that is by the household sector that is in home ownership status versus how much paid by those in renter status.
Okay, I follow that, but if I wanted to get a little bit more granular and just assume we have a population of 31 million in this state, if I wanted to know how many of those folks pay property tax directly, how many don't, and and then by way of comparison, how many of those folks are we assuming pay sales tax? Is that, I mean, I'm not trying to get you to do something you don't do, but I don't know if that's something the comptroller has looked at least internally.
Not that way, but I can look and see what we can come up with and get back to you if that's okay.
Sure, and maybe post-meeting, we could take a meeting in my office, we could talk about it.
Okay.
Thank you.
Yes, sir.
Thank you.
Please proceed.
Thank you, Madam Chair. Turning to page 9 of your handout, I provided a breakdown of the different types of sales tax filers, monthly, quarterly, and annual, along with the number of filers in each category and how many filed electronically as of this past January. Permit holders that have $1,500 or more in tax per quarter are required to file monthly on the 20th of each month. Permit holders that have less than $1,500 per quarter are required to file quarterly in the month following quarter end, and then permittees that have less than $1,000 to report during the calendar year can file annually in January of each year with controller approval. As you can see, about 65% of all sales tax returns are electronically filed with the agency. The agency continues to work hard to try to build out and improve our online web file tools to try to encourage taxpayers to file electronically, which of course produces efficiencies for both the taxpayer and the agency. The final 2 pages of your handout cover other major taxes. It's very highly summarized. In the interest of time, I was not going to go into those other taxes other than to list them there for you, along with their rates. And of course, we are always happy to provide whatever history or information the members might need regarding any of these specific taxes going forward, including staff resources who are our subject matter experts in these various tax areas. And Madam Chair, that concludes my prepared remarks. I'm happy to try to answer any questions.
Mr. Ashley, you are very popular. We already got 2 representatives lined up for questions. First, the chair recognizes Representative Chairman Caprillion for his question.
Thank you, Madam Chair. Mr. Ashley, I just had a quick question on page 5 of your handout. We note that 315,000 or so of the 346,000 of the reports are filed electronically. And so I guess my question is, why are not 100% of the reports filed electronically? Is it because we still allow people to do paper and people prefer it, or is it that maybe we're just not capable of doing complex or whatever the issue is?
Yes, sir. So we still allow taxpayers to file based on paper, and we do have some that do. A lot of taxpayers, because they only remit $1,000 or less in tax per year, are allowed to file annually, and so for them it may be easier to just fill out a paper return than to do that electronically. We are aligned representative. We are trying to encourage and push as many taxpayers as we can to electronic filing. It's certainly more efficient for the agency. Right. It's more efficient for the taxpayer as well, but there is definitely a lag there in terms of taxpayer adoption.
Do you think they're, I guess to say, like, let's say it was required, would that really cause a problem for some of these individuals?
It could. I think of my own mother who runs a small, she runs her local community's water well, and so she has to file reports with us, and for her that annual filing process is a big deal, and so she prefers the paper option. So there are those kinds of situations. Certainly if you want to get to 100%, then a hard and fast requirement in statute that the agency enforces may be required to get there. I'm sure it would be.
Yeah, I'm just curious. Thank you.
The chair recognizes Representative Gervin Hawkins.
Thank you, Madam Chair. This is a question on when we increase the threshold for filing franchise taxes and or paying, how much money has the state lost because of that?
So that was Senate Bill 3 from last session, and I believe the revenue loss associated with that increase to the no tax due threshold was approximately $300 million per year, so $600 million for the 24-25 biennium that we're in, and of course that would carry forward into future years as well.
Okay. The other question I have, just for a point of clarity, when we talk about that margin is defined as total revenue less the greater of, help us understand that a little bit. Particularly, I'm looking at item on your slide 3, compensation, salary per employee capped at $450,000.
Right, so the tax is based on the tax rate as applies to the calculated margin. And so to determine the company's margin, you start with total revenue, and then companies are allowed to make one of these 4 deductions that you have listed here for you on the slide. And they would presumably elect to use whichever deduction results in the least amount of base upon which the tax is calculated. And so for a company that manufactures a product, they are allowed to deduct their cost of goods sold as an option. Companies are allowed to deduct employee compensation, but they are statutorily capped at only including positions that are less than that threshold you see there of $450,000 annual income. So employees that are making above that, they are not allowed to include for purposes of that compensation deduction. So it's a way that the legislature has limited how much employee compensation can be deducted for purposes of calculating the tax.
So a company selects one of these or all of these?
One of them may apply.
So if I had this mega tech company and I was paying everybody $1 million, the most I could reduce it by is $450,000.
Well, you can include any employees that are being paid under $450,000 or less would be included in that deduction.
All right, thank you.
Yes, ma'am.
Mr. Ashley, you are even more popular than I thought. So we have Representative Turner and Representative Trosclair anxious to ask questions. The chair recognizes Representative Turner.
Thank you, Madam Chair. Just a quick question. On the tax exemptions and tax incidents book you gave us, which is very helpful. So on page 71, you've got a couple of charts related to the school property tax optional exemption up to 20%. That's a homestead optional exemption, I presume is what that refers to.
On page 71, I'm sorry.
71 at the bottom.
Which table? Table 37?
Table 37.
Yes, that's the optional exemption.
Yes, okay. Do you have similar data for the optional city and county sales tax, or I'm sorry, homestead exemption?
Do you know, Brad?
That can be provided? I didn't see it in this book, but
We will not have estimates of this nature for them
okay.
because we're only, in this report, we're statutorily required to include only school property tax.
Okay.
So this report won't have anything about city and county property taxes.
Does the Comptroller's office collect that data at all to know what, how many cities and counties out there offer an optional homestead exemption?
Yes.
Okay. Would you be able to?
We'll be able to get that data for you.
Okay.
Allison will speak to that, but yes, they have it.
Would you be able to extrapolate, looking at the incidents by quintile, would you be able to run a similar analysis or?
Yes, not rapidly.
Okay.
This particular analysis is done in largely with a model at LBB right now. So we would need to work with Legislative Budget Board staff to
Okay.
do that. But
Okay. Well, I'd be interested in whatever data may be available, just to look at that and compare it. Thank you.
But yeah, your incidence will be slightly different for those taxes than for school tax because of different exemption policies.
Sure. And varying percentages depending on the jurisdiction, I assume too. Yeah. Okay.
Okay.
Thank you.
The chair recognizes Chairman Cody Vassa's attendance. Okay. All right. Now, go ahead. Chair recognizes Representative Troxclair.
Thank you. So going back to page 5, where we're talking about the total number of franchise taxpayers with filing responsibility, if there are so few people who actually report or actually owe a tax, why do we require such a high number of people to report? I mean, again, your example of your mother, the small, I mean, I just know that sole proprietors and a lot of small businesses, this is an extra burden, and I'm assuming that it helps the state keep track of who owes what and when, but can you help me better understand why there's such a disparity between the number of people with the responsibility to file and the number of people who actually have a tax due?
Certainly, and one of the things I would point out, Representative, and another part of Senate Bill 3 last session, not only did it increase the no tax due threshold to 2.47 million, so that taxpayers that have revenue below that amount are not required to pay any tax. Not only did it make that change, but it also eliminated the requirement that existed at that time that they have to file a franchise tax report with the agency. So this 2.9 million represents taxpayers that are registered with the controller as a business or entity that may have a tax responsibility, but depending on their revenues, they may not, owe tax or even have a reporting requirement.
Okay, thank you. So that has been recently changed, and
Yes.
the number of people that have that responsibility is decreasing.
Correct.
Okay, wonderful. And then I also wanted to ask a general overview question. When we are talking about the surplus or the economic stabilization fund, the amount of oil and gas revenue that is being transferred, and I'm assuming either one of you could maybe answer this, is in the 5.9 billion range. I often hear, we're the surplus is because we're over collecting property taxes, but is it accurate to say that the surplus is mainly driven by sales tax, severance taxes, franchise taxes, not necessarily a property tax?
Property tax would only have an indirect effect on that because the state does not actually levy a property tax. However, public school system is jointly financed between state appropriations and local property taxes levied by the independent school districts. When local property tax bases grow faster than was anticipated when a particular budget was written, then those local property tax, school property tax collections grow faster than anticipated. That replaces part of the money that you had appropriated from state funds to go to schools. If local property taxes grow faster than expected, then the draw on state general revenue to complete the school budget becomes less. We do get that pretty frequently. We end up with, because we often have forecast property tax growth conservatively, and then if taxable values grew faster than anticipated, you had more property tax revenue collected at the school district level, and then therefore you spent less state general revenue to complete the school budget. That is a factor in the surpluses that have happened in the past. I wouldn't say that's necessarily the largest factor. Again, I really want to stress the budgetary situation we're in now and the size of it is really unique historically, and it happened because of dynamics in the pandemic when we had a lot more federal funds come to the state and budget writers were able to substitute federal funds to finance things that are normally financed with state general revenue, combined with the takeoff in inflation and the really astonishingly high growth we had in just a couple of years. Fiscal 22 and 23, we had really abnormally high growth in state tax revenues. That's gone. I mean, in our most recent fiscal year, state taxes actually declined very slightly from 23 to 24. But your surplus is really based on what happened in and coming out of the pandemic.
Great, thank you.
I hope that.
Okay, thank you very much. Now let's move on to Ms. Mansfield. For the record, your name is Allison Mansfield, and you are testifying on behalf of the Comptroller of Public Accountants. Is that correct?
Yes, that's correct.
Please go ahead.
You should have a presentation in front of you called Introduction to Property Tax, and that's what I'll be working through. Just a quick overview of what we'll be covering. We'll be going over the property tax system, the local appraisal, equalization, local assessment collections. Then I'll be talking about what we do in the Property Tax Assistance Division at the Comptroller's Office. And finally, I will throw a bunch of data at you. So property tax is locally assessed and locally administered. There are two constitutional provisions that we point to. There shall be no state ad valorem tax shall be levied upon any property within this state, and there shall be no statewide appraisal of real property for ad valorem purposes. Next, you have a property tax system calendar. This calendar, our property tax cycle follows the calendar year, and we're broken out into 4 phases: the appraisal phase, equalization, assessment, and collection. And so this calendar is a really nifty tool. It just kind of walks you through each of those phases and includes some of those statutory dates that are within the cycle. So next we have our local appraisal side of things. And this is really the kind of nexus of what happens at the local level. It's the appraisal district. It's a political subdivision of the state. The boundaries of the appraisal district are the same as the county. It is responsible for appraising property for ad valorem tax purposes. There are actually 253 appraisal districts, and that's thanks to Potter-Randall Appraisal District, which is consolidated under Tax Code Section 6.05, subsection B. The state does not appraise property for ad valorem tax purposes, although we do have appraisers at the state, and I'll get into that when I talk about the school district property value study. The Appraisal District Board of Directors. They have general duties is to hire the chief appraiser, adopt appraisal district operating budget, hold board meetings at least once each quarter, appoint a taxpayer liaison officer in counties with a population of 120,000 or more, and adopt a reappraisal plan. We now have 2 different kinds of boards of directors. We have board of directors in less populous counties and a board of directors in populous counties, and that is a change that came out of SB 2 from the second called session last session. There are approximately 50 counties that fall into the populous counties bracket, and they all had those 3 elected board members that took office just last year. The chief appraiser is hired by the board of directors. Their general duties include to appraise all property at market value as of January 1. They approve or deny exemptions and special appraisal applications. They prepare and mail notices of appraised value. They create and maintain the local property tax database, certify the appraisal roll, propose appraisal district budgets. In order to be a chief appraiser, you do have to be licensed. You have to be a registered professional appraiser, or you have to have an MAI, an AAS, a CAE, or RES, and you have to become certified as an RPA within 5 years. Again, all appraisal for property tax purposes happens at the local level. Per Tax Code Section 23.01A, all property must be appraised at market value as of January 1. Market value is defined in the tax code under Section 1.04. And all real and tangible personal property is taxable unless otherwise exempt by the Constitution. For appraisal purposes, there must be compliance with Uniform Standards of Professional Appraisal Practice, or USPAP, when performing mass appraisal. Most often, appraisal districts use mass appraisal to appraise property for property tax purposes. It's just easier when you have so many properties to appraise. Mass appraisal is a systematic way to value a group of properties using standardized methods and statistical analysis. And so they have to comply with USPAP, but it is a way that they appraise property. We usually get a lot of questions about that, so I'm happy to answer anything if you have questions. Also, I was asked to speak a little bit about tangible personal property and how that's done a little bit differently than residential property or commercial property. For tangible personal property, a rendition will have to be filed. A rendition identifies, describes, and gives the location of real or tangible personal property, but business owners are required to render a good faith estimate of the market value of their income-producing tangible personal property. The property owner may also provide the historical cost new and the year of acquisition of the property. And they provide this information to the appraisal district about the market value of their income-producing tangible personal property. The appraisal district is not required to use that value information when they notice on the property, but the business owner is required to render the value. There are penalties associated if the business owner fails to render or if they file a late rendition. Next, we kind of move into the equalization phase, and that's handled by the Appraisal Review Board. The Appraisal Review Board in populous counties, that's that population of 75,000 or more, they are appointed by the Board of Directors. In less populous counties, the Appraisal Review Board is appointed by the local administrative district judge. The ARB adopts hearing procedures. They hear and determine protests. They hear and determine challenges that are put forward by taxing units. They correct clerical errors to the appraisal records, and they approve the appraisal records by July 20th of each year. The ARB is supposed to be kind of a jury of your peers. They are not intended to be experts on appraising property. Next, we move into the assessment and collection phase. Taxing units are required to adopt tax rates annually. The tax rate is to fund debt service, and a tax rate to fund maintenance and operations as determined by the proposed budget. We have a very robust truth in taxation process in Texas. That involves the calculations, the publications of notices, and public hearings are required to provide transparency and inform the public on the proposed budget and tax rates prior to adoption. There were reforms in 2019 that limited the amounts that cities, counties, and special districts can increase their tax levy without voter approval. And it also created the texas.gov/property tax, where you can go to get all of your property tax database information. You can, in those databases, find your property and look up to see when the taxing units are going to have their when they're going to have their hearings on their proposed budgets and proposed tax rates. Moving on to some of the things that we do at the Comptroller's Office, we have our school district property value study. The purpose of the study is to ensure the equitable distribution of school funding for public education. It is indirect equalization. The school district property value study does not change values at the local level. Right now, in our school district property value study cycle, we just released the preliminary results at the end of January. So we are now kind of moving into the protest process. School districts have 40 days from the day that we release the preliminary results to file a protest on the preliminary results. The deadline for that protest this year is March 12th. For the school district property value study, there are several possible findings that you can have. You can be valid, and that would be a valid finding within the school district property value study, or a school district could receive a valid finding because they're actually having a methods and assistance program review rather than a school district property value study. You could receive an invalid finding and be in grace year 1, grace year 2, or you could have an invalid finding where your local value is greater than the state value. And then you can also receive an invalid finding where you would be at what we call at state, or where we would certify state values to TEA for purposes of the school funding formulas. That grace period is very important to school districts, and it is where we provide kind of, well, a grace period, where we certify local values for 2 years. And this is where the state is really offsetting the loss in local property tax revenues due to property values being lower than market value. In order to qualify for grace, a school district has to be deemed an eligible school district. So they have to have an invalid finding in the current study. They have to have a valid finding in the 2 preceding studies. Their local value it has to be above 90% of the lower limit of our confidence interval. And the appraisal district must have passed the mandatory requirements of the most recent Methods and Assistant Program review. To get into some of our 2024 preliminary findings, this year we studied 694 school district splits. A split school district is one that has a jurisdiction in more than one county. PTAD, Property Tax Assistance Division, we do not study all school district splits. There is a threshold of value that we study. So there may be a split in a county that's just too small. There's not enough value there, so we don't study it. But this year there were 694. Of that, 581 received a valid school district property value study finding. We had 22 districts this year that were at their local value was greater than the state value. 27 received an invalid finding that were within the grace period, and 64 received a state finding. The next slide breaks down those invalid findings kind of a little further. So we see those that are at state, those that are grace year 1, grace year 2, and then those that have the local value that are greater than the state. In total, we had 113 school district splits that were invalid. The next slide looks at our 2024 preliminary findings by tier. And when we say tier, we're breaking out the counties by population. So our tier 1 is counties that have a population of 120,000 or more. Tier 2 is less than 120,000, all the way down to 20,000. And tier 3 is less than 20,000. And that just kind of shows you amongst those tiers the percentage of those districts that are within each of the categories of valid or invalid. The next slide is one that we're starting to show that gives you a really good idea of what's happening with our invalid school districts with an overlay of the Texas median sale price. And it's kind of what we anticipate. As the market is increasing, we see an increase in invalid findings, and as the market is stabilizing, we see kind of a drop-off or a stabilization of the number of school districts that receive invalid findings. We saw a pretty big uptick in the number of invalid findings for our school districts during COVID. COVID was a crazy market. No one really knew what to expect, and so appraisal districts really struggled to keep up with those growing markets. And so we did see an increase in the number of invalids, but now from 23 and even 24 preliminary, as we see the market kind of coming to a more stable place, we see a drop-off in the number of invalid school districts. Next, we have our Targeted Appraisal Review Program, or TARP, as we like to refer to it. The purpose of this program is to really go into an in-depth review of appraisal districts and provide recommendations on appraisal standards, procedures, and methodologies. The TARP is a triggered program, so in order to receive a TARP, the TARP is for the appraisal district. However, in order to receive a TARP, a school district within the appraisal district has to receive 3 invalid findings, consecutive invalid findings. Once a school district receives those 3 consecutive invalid findings, we will go into that appraisal district and do an in-depth review to see what's going on. And we will provide recommendations within a report. We actually just released our first round of reports. We just concluded our first round of reviews for this program. It went into effect back in 2019, but the first study that was for the, counting as number 1 for that first of the 3 consecutive invalid findings was the 2020 study. So after the 2022 study is when we first were able to conduct a TARP review of an appraisal district. We recently released those reports, I think at the beginning of February. And on the next slide, next couple slides. The next slide actually shows for the 2022, we had 32 appraisal districts that received a TARP review. In 23, we're looking at 29, and based off 2024 preliminary results, there will be 20 appraisal districts receiving a TARP review. There's some overlap there between ones that have already received a TARP review and the ones that will receive another TARP review based off of the following school district property value study findings. Some of the common findings that we are putting forward recommendations on are to conduct staff and chief appraiser evaluations, to hire additional staff, to train staff on the systems that the appraisal district uses, to update maps to reflect that all properties within the appraisal district are present on the maps, to categorize properties correctly, to regularly conduct local ratio studies and use the results to make appraisal decisions, to review and update cost schedules, and to collect all available data. So what we're really seeing with these TARP reviews is that there is a resource issue with some of these appraisal districts. Either they're not able to fund a budget to pay appraisers or pay to hire additional staff, or they are struggling to be able to conduct the appropriate ratio studies at the local level. So that's really what we're finding are the resources aren't there at the appraisal districts. We do believe that these TARP reports are going to be a great tool to kind of find out for a lot of those school districts that have consecutive invalid findings, what's really going on at the appraisal district and why are they continually receiving an invalid finding. So we'll be pointing to those reports and the results of those reports when people ask us those questions. They are available on our website for anyone to go see. Next is our appraisal district ratio study. The appraisal district ratio study determines the degree of uniformity of and the median level of appraisal by appraisal district. So this study actually measures the accuracy of the appraisals that the appraisal district is conducting, and it is a good comparison of uniformity among appraisal districts. So you can actually use some of the numbers within this study to look at how your appraisal district is doing compared to a neighboring appraisal district in terms of uniformity of appraisals. We also have our Methods and Assistance Program. This program reviews appraisal districts on governance, taxpayer assistance, operating procedures, and appraisal standards, procedures, and methodology. We provide limited scope reviews to certain appraisal districts, for certain appraisal districts that have in a disaster area, and then also ones that have received certain designations. Through the Methods and Assistance Program reports, we provide recommendations and report to the chief appraiser and the board of directors. We also provide these reports to superintendents and boards of ISDs. Now for all that data. So we have a couple of graphs. All of these graphs that I'm showing you, well, the next couple of slides at least, are pulled from our biennial report. This first one shows the tax revenue by source. And I think Philip and Brad kind of talked about some of our state taxes, but this breaks it down to show you that property tax in relation to the rest of state taxes, property tax is 46.05% for 2023, compared to the state sales tax, which was 26.34%. The next slide shows taxable value by category of property. And here we're looking at single family versus multifamily, commercial real property, and also commercial personal property. That other category, that's pretty much everything else that's not listed there. Next, we have tax levies by taxing unit type. Of course, we have school districts, cities, counties, and special districts. You can see a major difference between 2022 and 2023 for the school district slice of the pie. It dipped from 54.4% to 48.5%, and that is in big part to the increase in the residence homestead exemption and the compression for the school district tax rates. The next chart shows the number of taxing units from 2019 to 2023. And this chart is really the main thing that grew is the special taxing units. Counties obviously stayed the same over that period of time, but we see growth in special purpose districts from 1,809 in 2019 to 2,246 in 2023.
Ms. Mansfield,
Yes.
hate to interrupt, but I believe a couple of members have questions.
Oh,
First,
of course.
Representative Noble.
Thank you, Mr. Chairman. So the school districts have nothing to do with the appraisal process.
That's
Um,
correct.
But they are held accountable when the appraisals are off.
So first, I will say the school districts do have, they do not have a part in the appraisal process. They do have a vote in the board of directors. For the board of directors that are appointed to the appraisal district, the school districts do have a vote in appointing the board of directors
Yes,
to the
but when
appraisal
it-
district.
So when the appraisals are done, they're not involved in that process.
That's
at all.
correct. I just wanted to make sure that there was an awareness that they do have a appointment to the board of directors. And in terms of holding accountable, the school district property value study and the purpose of it is to ensure equitable distribution of state funding to public education. The mechanism that the legislature decided to use to ensure that equity of distribution was to make sure that the locals are appraising property at market value across the state. And as it was pointed out earlier, because school districts are funded on a local and a state share, it's first funded at that local share. And the locals need to be taxing at their maximum tax effort, and then the state comes in and fills up the gap. If the locals are not taxing at market value, there's the possibility that the state is overfunding, or if they're over market value, underfunding that local school district. And so the mechanism the legislature decided to move forward with was the school district property value study to ensure that we have that market value across the state. What happens is
I haven't gotten to my question yet. So you're
Okay.
filling in stuff that I didn't ask.
okay, well then go ahead and ask the question.
So,
Sorry.
thank you, though. I get that. But let me just be clear about this. They have no ability to decide what the appraisal is. That was the point that I was
Correct.
making. And yet, you come in and do this and you do an appraisal. So here's the question. Are you comparing the exact same day that the appraisal was done when you do your reappraisal? Are you looking at the exact same point in time that the original appraisal was done?
So our appraisers we appraise property as market value as January 1. So when we look at our data, we will look at using, you know what, I'm gonna have to get back to you.
Okay, because that's a complaint I've had.
Yes,
From
so-
our school districts, and here they are having to settle up, or whatever it is, on something that they had absolutely no control over as a district.
So one of the things I will point out about this study is that we are looking in arrears. Property values have already been determined for the year, and then we go back a year later to look at what's already been done. So we've just released our 2024 results, and now we are looking at starting our 2025 after the appraisal districts have already had to appraise property for 2025. So we're going in after the fact. So we do have different data than the appraisal districts would have had at the time that they're conducting their appraisal.
So
there
it is apples and oranges at that point then,
Well-
for the homeowner, or for whoever.
Well, I will also note that there is an importance in the independence of our study. So there really shouldn't be the necessity for us to have the same data that the locals are using, because we are conducting an independent study of market value.
Okay, so do you ever find that a school district has overtaxed, that an appraisal district over-appraised?
So we do have a finding where the local value may be greater than the state value. So we do have that happen
And
on occasion.
and then, do you give money back to that local district at that point?
That would be more of a question for TEA, I believe, since our numbers are simply certified to TEA for use in the school funding formula, so I'm not sure.
So
that
this,
one.
this is what, I have been, because I think every one of my school districts have had this situation going on lately, and I don't know about everybody else, but it's real. And y'all blame TEA and TEA blames you. And so I'm just trying to drill down and find out why 32 districts, is what you said, are under this TARP review, why we aren't doing this, why this isn't more accurate from the get-go, and if there's adjustments that need to be made, that we can make that. Thank you, Mr. Chairman.
Chair recognizes Chair Capucleone.
Thank you, Mr. Chairman. And I think Representative Noble asked some of my questions, but I had a couple more, I guess maybe in terms of how the process actually works. So after the preliminary certification, there's a protest. And at that point, at a certain deadline, the school district can or cannot. I guess if they do protest, then what happens? Versus if they don't protest, I assume they just accept your findings and do that. But if they protest, what is the process after that?
So if the school district files a protest, we go through kind of an informal process where they file objections. We review those objections and we make recommendations. They're able to accept those recommendations or continue to object. Once we get to a certain point through this back and forth, then they can request to go to SOA.
Go to what? I'm sorry.
SOA. They can request to go to the State Office of Administrative Hearings, okay, and we'll take the arguments before SOA, okay, and that would be the conclusion.
Okay. So how often during that process, I hate to put it this way, but is there a compromise? Does the school district, is it either the school district or the county appraisal was correct, or the comptroller's numbers were correct? Like how does that usually break down in terms of what the final result is of the protest and the certification?
I could get numbers for you on that to see from the number that have protested kind of what the results of those protests are. We could get numbers for you on that to see.
Yeah, that'd be great if you don't mind. All right, so then I guess I don't understand what a what a grace period is. So let's say there's a finding. It turns out the state was correct in determining what the correct appraisals were, and the local appraiser was not. Then that's the grace period that they enter into?
So the grace period occurs if a school district receives an invalid finding, and the school district has received in the prior two studies, they've received a valid finding. The finding that in the prior two studies, they've received a valid finding. Their appraisal district did not fail any of the mandatory questions on the Methods and Assistance Program review. Their value is not greater than 90% outside the lower limit of the confidence interval. Then they would be eligible for the grace period. The grace period is a 2-year period. So during that 2-year period, we certify the local value to TEA for purposes of the school funding formula.
All right, so hold on a second. So basically, if you've been generally doing a good job, and now something happens and you're not that far off, you're just like, okay, good enough, we'll let you do that. But if it turns out that you're off by more than 10%, right? You're off by more than 9%, or you have a history of doing this, then you're not in the grace period anymore. Correct. And at that point, it says that the state offsets the loss in local property tax revenues. And so what does that mean? So what, do you all calculate, okay, well, if you had done it right or different than you had it, the way that we came to the conclusion, then you would have collected this much more in local property taxes. So how does that work? Do the local property taxpayers then get a supplemental bill, or?
No, the study doesn't impact anything at the local level in terms of local values or taxes that are paid by local property owners. All it does is have an impact on the school funding. So when we say that during the grace period, the state is covering the loss in the local revenue, it would essentially be when we are certifying the local value to TEA, we're saying, okay, even though we know that their local values are low, because they're in the grace period, we're going to assume that their local values are correct and that we're going to fund them as if those local values are correct.
Sure.
And so that's how the state is kind of making up the gap at the local level, is we're making the assumption that their market values are correct. If we were to certify our state values, the difference between the state value and the local value, that gap is really what they'd be missing out on in the funding, which oftentimes when people look at it, it flows through the school funding formula, and school districts feel as though they're losing out on state funding because that's where the loss of the funding is coming from when it hits them. But ultimately, it is a loss of local funding because they're not at
Sure.
market value.
But they will
on the
get less
local side.
funding, regardless of where it comes
Yes.
from. So the school district,
Yes.
if they are not in a grace period because whatever, or they're off by too much, then there's a risk that the school district will receive less funding from the state.
Yes.
Okay. And if they get less funding from the state, this is a question probably for later, but I'd like to know maybe how that impacts recapture too, right? Because, do you know?
That
Or-
is definitely not an area of my
Okay, all right,
expertise.
we'll skip that one for now. Then I have a question on one of the slides where you show the number of invalid findings versus the median sale prices. And for a while, it looks like it was correlated, right? That the number of invalid findings was related to the rising increase in medium home sales. But then it changed in 2023 and 24. Question one is, why is that disconnect all of a sudden, right, the last 2 years? And then the second one would be, do you find that school districts or local areas with higher median home sale prices tend to have more invalid findings?
That last question, I'm not able to answer.
Okay.
I don't have the
Okay.
data with me to answer that. But the first question, the drop in invalid findings is due to stabilization in the market. When we have a stable market, it's easier to appraise property. When we have in a market where you have higher appreciation in values, it can be challenging to keep up with that appreciation, and that's what we saw during those COVID years and why we saw such an
Okay.
increase in the number of invalids.
Got it. All right, thank you. Thank you, Mr. Chairman.
I think Vice Chair Martinez Fisher
Thank you, Mr.
first, and
Chairman.
then Chair Turner second.
So I heard you say something operationally on the property value studies that Comptroller goes in after the fact, is that what?
Yes.
And there aren't ever times where the value study sort of is anticipatory, that districts know what the value study is as they begin to appraise?
No.
Okay. So I guess, I mean, I understand the conundrum, right, of the agency, because it's your job to make sure values are correct, because we want to make sure we have equity and people are paying their part. States last dollars in when it comes to school funding. But it would seem to me operationally, if that is the goal, shouldn't our guidance be in front of local districts appraising so that they have a sense of what they think those values should be?
That would be a policy question that I would not want to expound upon. However, I will point back to those constitutional provisions that prohibit a statewide appraisal. I think you might run into the possibility of, if we were to do something more forward-looking, it might impede upon that constitutional prohibition.
It seems to me to be rather semantic. I mean, if you come in after the fact and say you're wrong and here's the number, how are you not appraising in the back end?
Our appraisals are not for property tax purposes.
Well, if there's but again, since we do the accounting, right, and we do the redistribution of those resources, that work product goes somewhere, and there are policy decisions that are made, most of those being financial, and your work product goes into that methodology. So again, it seems to me like if the goal, I guess statutorily, you said that's a policy question, statutorily, are you prohibited from, other than the Constitution, is there when the legislature set up the property value studies, that we say that they would be coming in on the back end?
Yes, that's how this study is set up.
Okay. And is there, in the property value study, what is the range that you could be under a certain percent or over a certain percent? What is that number?
So in terms of when to determine whether you're invalid or valid?
Yes.
Okay. So we have a margin of error, and statutorily, our minimum margin of error is 5%, and we're able to go above that when it's necessary. And when it's necessary would be for statistical reasons of sampling and variance. We often go above that 5% margin of error. The margin of error is then used to determine our confidence interval, and it's that confidence interval that if you were outside of that confidence interval, either on the low side or the high side, that would determine whether or not you're invalid or valid.
Okay, and so generally speaking, we're using a greater than 5% margin?
I would say our goal is to have a 5% margin of error, and the reason for that is the margin of error is really determining the accuracy of the state side of the study, and we want our numbers to be as accurate as possible. So our market value as the state is determining market value. We want it to be as accurate as possible, so we aim for that 5% when we can.
And when school districts find themselves in this dilemma, is there a requirement that they provide an FAQ, or how do we inform the general taxing public that a school district may or may not have hit their mark when it comes to their values, and sort of inform them so that they know, perhaps it may inspire somebody to want to run for the appraisal district? Is there any reporting requirements?
We have a reporting requirement to the school district and to the appraisal district board of directors. Outside of that, we do post all of the information publicly, but do not have any other reporting requirement.
Right, but that wouldn't necessarily find its way into an appraisal document that would give a taxpayer, like, maybe notice to go look, that there may be more information regarding the taxing entity.
I'm not sure if at the local level they may push that information out. I'm not sure.
Okay, thank you.
Chair recognizes Representative Turner.
Thank you, Mr. Chairman. Just a quick question to kind of follow up on the property value study questions. Once the Comptroller's office has completed its work, then do you provide a report to the Texas Education Agency basically with the results of the PVS for every school district in the state? Is that the process?
Yes, we certify both preliminary findings and the final findings for the school district property value study to TEA.
Okay. And then it would be, and I assume at that point, unless there's an appeal, like you mentioned the SOA process and all that, I assume at that point it's basically out of your hands. Is that right? It's in TEA's court to look at that data and then make a determination if a district needs to, by state law, receive less state funding. Is that accurate?
I'm going to say that's going to be a question for TEA.
Okay. Is it accurate to say it's out of your hands?
Yes.
Once you send that report to TEA?
Yes.
Okay, we'll follow up with TEA on the rest. All right, thank you.
All right, thank you. Please continue.
I'm through with my presentation.
Chair recognizes Representative Troxclair.
So the number of taxing entities that you have listed on this slide, how does that compare to the number of taxing entities in other states? We've got 254 counties, of course, school districts, 1,014 cities, 1,091, and special purpose districts, 2,246.
I don't have that information off the top of my head.
Okay. That just seems like a lot. Seems like a lot of people that have the ability to increase tax rates. So I would love to know, is that something
That's
that
something
you
we
can
can
find
look
out?
into.
Okay. Two more questions. So last November, 2024, in that election, we had about 60 taxing entities, I believe, that held tax rate elections to exceed the rollback rate, or the whatever our new name for it is. There's some school districts that increased homeowner property taxes by about $500 annually, which is just like shocking to me, because we work so hard up here to put all the money that we can towards buying down property taxes. And then, we have these situations where people don't quite understand the significance of those votes to go above the state cap. So I guess my question is, does the Comptroller track these tax rate elections? Are y'all tracking how many of these kinds of elections that are going on across the state?
So no, we do not. However, we are making an effort to do that in the future.
What can you expand?
I believe that we are looking at collecting that data for this upcoming year.
Okay. Is there anything we can do to support you in that, or you're already?
No, I think we're already making the effort.
Okay, great. Yeah. I think it's really important for us really important data for us to be able to have. So thank you for being on that. And then, it seems like we have created, while we have done so much to move the needle at the state level, reducing the rollback rate and trying to put reasonable guardrails and taxpayer protections on our tax rate elections, our bond elections, it still ultimately is not getting to the end taxpayer. And so, I know there's a discussion, there's lots of different tools in our toolbox that we can use. And I appreciate the governor wanting to put, another $10 billion this year and highlighting how many loopholes we need to close. But ultimately, is it possible for us to eliminate the tier 1 portion of our property taxes, the maintenance and operations portion of our property taxes, if we allocate our property reduction money to exemptions?
I'm sorry, I don't quite understand the question.
So if you have $10 billion, if you put $10 billion to homestead exemption, can we ever eliminate tier 1 property taxes?
That would not be your method. Because
I just want a simple yes or no. I don't need a.
Okay, no.
Okay, great. And so if we put about $10 billion a year to compression and buying down M&O and tier 1 taxes, could we theoretically eliminate that portion of our property taxes, within the next 10, 15 years?
If you had an additional $10 billion per year to add?
Per biennium.
Per biennium? Conceivably over that period of time, if you continued to have that much additional revenue to commit to property tax reduction, yeah.
So it's accurate to say that as we are appropriating money to try to provide property tax relief, long-term tangible property tax relief to Texas citizens, the only way to eliminate that portion of our property taxes, the biggest portion of our property taxes, is through compression rather than exemptions.
Well, unless you're doing exemptions for both homestead and non-homestead property. If you do exemptions for non-homestead property as well, then you can use exemptions to get there. But those exemptions apply to both Tier 1 and Tier 2 and any other rate levy that goes into the total school district rate.
Maybe this is a easier way to ask this. The quickest way to eliminate Tier 1 property taxes is through compression over a homestead exemption.
Correct.
Thank you.
Assuming you want to eliminate it for all forms of property.
Thank you.
Members, any other questions? Very good. Thank you all for your time. Oh, I'm sorry. Chair recognizes Representative Perez.
On the property value study, I was just curious, how do challenges to appraisal districts impact the valuations at all that are used in the property value study? There's a large volume that ultimately goes to the ARBs, and then ultimately from there from the ARBs, it ultimately goes to district court. Do any of the changes in valuations impact the studies at all or any of the findings?
So if one of the sampled properties that comes up in our study, if that property had gone through a protest, and there was an adjustment made at the ARB level, then we do make a corresponding adjustment in our study to the value of the sampled property. I believe that if a property that is sampled is pending under an appeal to district court, we do not use that property in our study.
Okay. So the value has to be reconciled within the same year as the original, assessment done by the appraisal district?
We do make an adjustment, yes. So
Okay.
There's a reconciliation.
Is there any analysis, whether done by the comptroller or anywhere else, that looks at the differences in valuations? Perhaps maybe we have one jurisdiction in West Texas or another one in East Texas, based on the changes that go to ARB and lawsuits. Is it possible there's a 5% deviation, a 10% deviation, or has anybody looked at that across statewide?
I don't believe anybody's looked at that. We do have some data through our operations survey that we collect on ARB adjustments in every county and also on some data on litigation, but I don't believe anybody has conducted a study across appraisal districts on that.
Thank you. Thank you, Mr. Chairman.
Members, anything, other questions? If not, thank you all very much for your testimony. We appreciate it. Chair calls